Hello, everyone, and welcome back to another episode of Market Bites. What a 7 days it has been. So, Neja and I are going to go through it all. Before we do, Neja, how are you?
I'm doing well, thank you. It's been a very volatile week. Also, like in life in general, spring is starting. Allergies are back up, and my baby got sick, which is not the best thing ever. So yeah, it's been kind of a busy week. How are you, Sam?
Yeah, not bad. I've actually felt a little bit worse for wear as well until today, actually. But I tweeted earlier that the weather in London is like the markets at the moment. It's incredibly windy and volatile. And yesterday there was some sun, and who knows what tomorrow will bring. So I think a lot of people are feeling like the markets are at the moment. And there's a lot of indecision. And as always, at the moment, we should say the exact time we are recording this podcast because you just don't know what's going to come out. So it is the 12th of March and it is 2:30 in the UK at the moment. People can work out the time from there. But we're living in a period where it's very headline driven at the moment. We can talk about scheduled releases, of course we can, but we could release this, we could go live with it. People could start listening and be like, hang on, oil prices are 20 or 30% higher or lower. So it's been an incredibly volatile 7 days and an incredibly interesting start to the year, hasn't it?
Yeah, it was. I think that with every episode we say we have no idea what will happen in 7 days' time, and it's always like that. That we get so many surprises, and even during this period, from recording one episode to another, we have such big price moves. We saw that in oil. Obviously, oil is one of the hottest topic right now, and the moves that we saw in the past week are just I can't remember when was the last time that we saw moves like that. And like Sam, can you discuss a bit about price moves that we had in the past week?
I mean, it's been incredible. It's been incredible. I mean, each morning and throughout the day, I've got six charts in front of me at all times, just to get a feel of what is going on. Oil, Nasdaq, Bitcoin. I've got the FTSE just because obviously I'm UK based. The S&P and gold, and oil was leading them all. So if we go back to where we started the week with oil, we got up to nearly $120. And just on that, I mean, we're recording this Thursday, Friday, tomorrow. Naturally, that's what happens. And I've already started to think, are people going to be happy to hold risk assets over the weekend? Because we saw what happened with oil, how it spiked higher over that weekend. And I do wonder whether risk assets are going to come under pressure into the back end of the week if we don't have any new headlines. And even if we do, but anyway, so oil got to $120, and then you saw things from Trump saying it's not going to last long, and there's a few more positive headlines, and oil actually dropped in less than a day, 35%, which is just insane. That size move, and in that period, as oil goes down, equities came back up, and you start having people thinking, okay, we're going back to the all-time high here. However, things can change very quickly, and they did. We had, stories overnight and throughout the morning of vessels getting hit, and oil, therefore, went higher. However, not too long ago, throughout this morning, even into the early afternoon, oil prices then moved lower off a headline as the IEA reported they're going to release 400 million barrels of oil from its reserves, and that would be the largest such move in history. So that in that period made the sentiment improve a little bit. However, it hasn't really been a long-lasting effect, and oil at the time of this is trading at $95, and a couple of hours ago it was down at 90, so it's already up quite significantly. As we're recording this, equities are coming under pressure as well. By the time we finish it, there could be a new headline and it's all reversed. But it did start, me wondering, you don't really come out and release the most amount of barrels of oil you've ever done in your history if you don't think this is going to be long lasting, maybe. So I feel like the market off of that is a little bit spooked, despite what other people say, how it's not going to be long lasting. We're nearly at the end of it. And it's just a lot of conflicting headlines all the time. So it does make it tough. I can understand why some traders prefer to be on the sidelines. I can understand why some people are looking to, hedge with the VIX and all of that, VIX related instruments and all of that kind of thing as well. It's been a remarkable few days just for this week, but it doesn't really feel like it's going to stop. The move that we've seen, from sort of late last week to where we are now, which I think oil prices were 36% higher last week, right? Which is the largest ever weekly increase crude oil futures have ever seen, ever. And I think the most amazing part about this, and they're calling it Six Sigma event. So it's the speed of that movement, and obviously it's led to that price increase. A Six Sigma event. I mean, I don't know if you'll know this. I definitely wouldn't have, but that suggests it should happen one in how many years do you think, Neja? How many? Give me a guess.
Oof, I would say thousands and thousands. It's such a rare and unpredictable move that we saw. I think the chance of this move repeating in our lifetime is basically zero, I would say.
Well, it's absolutely definitely zero. One in every 4 million years,
No
a
way.
Six Sigma event, which is remarkable saying that. But it did get me thinking as well when I was reading that. Over the last few years, things happen a lot quicker. By the dips are being bought up a lot quicker. Reactions to earnings, they're happening a lot quicker as well. Because of news, because of algos, because of availability to make market related decisions, everything does happen quicker. But one in every 4 million years is remarkable. But also looking at oil prices, if we think of the move that we've seen, if we go sort of 60, $70 to 120, it's very similar to what we saw a few years ago, isn't it, Neja?
Yeah, if at least for Europe, if we think a few years back, 2022, it was a big energy shock for Europe as well, and it got maybe many investors thinking is how is this situation different from what we saw years back? Because Europe is definitely in a bit of a different position that it was in 2022 energy crisis, but it's still fresh in our memories because back then that problem that we had was extremely concentrated. But for now, I would say the situation looks quite different because Europe in 2022, we realized that we are really dependent only on few sources of energy. From 2022 up till now, Europe started aggressively diversifying their energy supplies, and the region started importing gas and oil from different markets, different countries. So we are not over relied only on one source. And also, I would say that difference from 2022 to now is macro environment, because in 2022, there was global economy, it was a bit overheating. Demand was very strong and governments were still spending aggressively after pandemic. You still remember, from 2020 to 2022, there was a lot of money oversupply because we were dealing with pandemic and shutdowns everywhere. Back then, demand was very strong and governments were still spending aggressively. But today, growth is a bit slower and inflation is already cooling down in many regions. And all of that, I would say that reduces the risk of uncontrolled inflation spiral that we were so afraid of back then. But even though Europe is still not immune, the region still imports large portion of its energy, oil and gas from the region that is currently under pressure. So anyway, we are still under pressure with transportation, electricity costs, and also industrial production. Maybe Europe is more resilient than it was back then, but still we can feel disruptions, and some of the industries that feel the pressure with high oil prices are definitely airlines, for example, because their costs are very, very related to oil prices, and they will definitely feel the pressure of higher prices on the market.
Yeah, and just with oil prices, I mean, I can sit here and give my 2 cents on whether I think we're going to be higher or lower next week, but it's a guess. It's a gamble, really, because I don't know what the headlines are going to be. I guess my gut feel about the situation is that it's not going to drastically improve in 7 days' time. I just don't think you release that many barrels of oil if you think it's going to be easy to sort this out. And maybe if we had done this podcast yesterday when oil dropped 35%, I might feel a little bit different about it, though. So I guess the truth is I'm just not sure, but I'm probably less positive about it being sorted quicker than I was 24 hours ago. And yeah, we'll have to wait and see. I mean, just looking at the traffic in the Strait of Hormuz, you previously sort of had between 90 and 100 vessels a day that would go through that. Then it dropped with everything that went on to about 10 a week. Massive decrease there. If you're talking 100 a day to 10 a week, then it went up to about 50, and then overnight and today it's now basically zero again. So that's a big change. And if that continues to go on for a long period of time, oil price direction is going to be to the upside. Equities are going to come under pressure. Airlines are going to move lower. On the flip side, we're going to get a positive headline, and people buy the dip in markets that have come under pressure if they feel like it's going to get better. And if we talk about inflation in the States, obviously we had CPI out yesterday, and bang in line, but it almost was an irrelevant number because it's not taking into account what we've seen at the moment. And people that look at oil prices and US CPI over a long period of time, they track each other pretty well. So the impact of that will be interesting to see. If we go back to late December, I think the Fed people were expecting the Fed for 2 cuts. I think it was this year. There's an argument if this goes on that it won't be a cut, it'll be a hike at some point. If we think back to 2022 and Biden and Powell got it wrong, inflation is going to be transitory. It wasn't. So worst case scenario, that's what happens. But I have to say, I just don't know. I just don't know where we're going to be in 7 days. And on one hand, that's exciting because markets are ever changing. There's always something to talk about. On the other hand, it's frustrating, isn't it? I suppose if you're like a longer term investor, you don't really want all of this noise. Whereas if you're a trader, it's fantastic, honestly. And I've, as I said, been looking at the charts every day, and I've just been, oil isn't something I like trading because of the volatility. But this week I've been trading it on the demo account, which always makes it easier anyway, because on the demo, everyone makes money. But I've made some incredible trades, honestly, this week with everything that's gone on. I know if I was to do it on a real account, I would lose. But yeah, it's been an incredible market for traders out there, and I think a lot of people would have done well. But also on the flip side, a lot of people would have struggled, and a lot of hedge funds have lost money as well, probably because of the speed of the movement of some of these trades that we've seen. I go back to say it was the biggest weekly increase ever in the shortest period of time. That six sigma move is unprecedented. It really, really is. And we fast forward a week, Nezha. I mean, who knows? Who knows what we're going to be talking about?
Yeah, it's very a difficult time for investors to position themselves. Even I feel under pressure, like what to do. Is this situation going to last? Because no one knows. As you said, we have no idea what will happen in 7 days' time. And whenever someone says they know, they have no idea. It's impossible to predict. But anyway, even if it's difficult for us as investors, I think that central banks have even more difficult decision to make, because we got inflation data, but it's, as you said, it's not that relevant because they didn't take in consideration the event that we had, and we are still waiting for this report in following months. We will see what was the effect on inflation in following months, and it was not reflected in this report. But definitely this event is something that central banks are watching closely, because energy prices feed directly in inflation because they affect transportation, household expenses, and when oil rises sharply, those higher costs can quickly show up in fuel prices, airline tickets, and even food production, which is definitely reflected in the number of inflation. However, the inflation dynamics today are very different from what we saw if I compare again to the period of 2022. Because back then, inflation was already escalating across almost every category, and energy prices acted like additional push to that. But today we see that inflation is gradually cooling in many economics. So what higher oil prices could do is like slow down this disinflation process. So instead of inflation falling back steadily towards the targets that the central banks want to see, we might see it stabilize and slightly above the target for longer. But yeah, that's just how I'm thinking for the future reports. But still, we have no idea for how long this disruption will last and what big of effect it is going to have on different industries and on households as well. But definitely, it's something that we need to take in consideration for the following months.
100%, 100%. The Fed meet next week, next Wednesday evening. I guess depending where you are in the world, it could be afternoon some places or Thursday morning others. But yes, next Wednesday, 7 p.m. or 6 p.m. actually, I think now because the clocks have changed for those in the UK. The probability of a rate cut next week is 0.7% at the moment, which of course is very, very, very unlikely that that is going to happen. And actually, over the last sort of few weeks, I've almost found myself wanting to give the Fed a bit of credit in that you've had all these people, big names, obviously Trump's been one of them, too late power and all of this, talking about how the Fed should be cutting rates to near zero, and you've had some big names in finance saying the same. But if things do get worse at any point, not just for, what's going on at the moment, but I feel like it's quite useful for the Fed that they've actually got a bit of room to maneuver, and sometimes patience can be rewarded a little bit. Yes, we go back to 2022, they should have hiked when they didn't, and that was, a problem. But yeah, I feel like they've actually managed it relatively okay, to be honest. But it'll be interesting to see what they say next week about the current situation and their thoughts and belief. Do they feel like they even need to consider hiking later this year, or are they actually, still in the favour of 2 rate cuts this year? So be fascinating next week, next Wednesday, to get the lowdown on that. I also thought it'd be worthwhile us talking about Oracle, who had their earnings out, and if I just have a quick look at the chart in front of me, so their all-time high was September last year, where they traded at $345. They're now trading at 161. On one hand, you've got the high of last year to the low of this year as a 61% move to the downside. On the flip side, for anyone that timed it absolutely perfect near those lows, you would be up 24% right now. Their earnings came out, Neja, and they spiked higher off of that. I guess people might be thinking, good, maybe this is the start of the recovery, or they might just be saying we've seen a few spikes in recent months and they've all just led to, lower lows. Are you somewhere in the middle, or, what did you make of their earnings report?
I think that what really impressed investors was how strong their cloud and AI numbers were. It's kind of not under the spotlight, this report, because of everything that's happening with
Yeah.
oil at the moment. But anyway, Oracle has been one of the players, and investors were kind of thinking, is that going to be one of the big AI players or not? But I think that this report kind of gave investors confirmation that they might be one of the big players in the AI world. And the numbers were good. Like if we take a look at the revenue, for example, it came in at about 70 billion for quarter, which is like 22% higher than a year earlier and above expectations. But I think that, yeah, the real reason for that jump that we saw was inside cloud business, because cloud infrastructure revenue really jumped. It jumped more than 80%, and AI infrastructure more than 200%, which it's telling us that Oracle is not just participating in this AI boom, but they actually are facing this huge demand for computing power and data center capability. their demand is still over exceeding the supply. So I also heard that management said that customers are asking for more GPUs and CPUs capacity than they currently have available. So I think that this is one of the things that the markets really like to hear, that the demand is so high that they cannot supply it that fast. And also one of the positive things of the report was that profitability was stronger than expected. So yeah, all of those things contributed to the jump that we saw, because previously investors were worried about this massive spending on AI centers. And I think that this report kind of eased those concerns around that. We saw that previously in all of the few earnings seasons back, that for all these big companies, investors are majorly worried about spending and where they are spending and if we see the results. So I think that this report kind of eased those concerns.
Yeah, I agree, and the reaction we've seen is very similar to the recent earnings season. I'm on about the reaction from September for Oracle, where people, like you said, have been worried about the capex, the AI capex, and we've seen that across the board, haven't we? With some massive companies. I mean, I think I haven't actually checked, but certainly recently anyway, all Mag 7 companies were in the red year to date. There might be one or two that are spiking above break even now, but you've seen it a lot. And I do wonder whether the broader market is a little bit less bullish on AI at the moment than they were 3-4 months ago. They need to start seeing those results come through, and earnings reports like this can help maybe change that narrative. But also, as you said at the very beginning, there's something else going on at the market. The attention of the market isn't necessarily on Oracle's earnings; it's on what's going on in the geopolitical situation and oil and all of these kind of markets as well. So I looked at the report, I liked it, and I could understand people saying, maybe it's a good opportunity to not necessarily buy the dip, but think about it. We traded at its low in February back down to where we were in May last year, which is coincidentally where we were in July the year before. So obviously with these things, it always, depends on your time horizon. If you bought on September the 18th, you're down big. But if you bought a few years ago, let's just say 3 years ago to the date, you're up nicely. Yeah, it's timing for a lot of it, but I like the company. I think overall there's still a lot of positive signs there. Yes, you want to see revenue really to start to outweigh the AI bill, and then it becomes a lot more, would look a lot more positive for investors out there. So
Like,
yeah, yeah,
I
I
think
think
that
overall.
I think that this earnings report really strengthens the bull case that investors have. But for if we have this long-term view for a few years, I think that execution will determine whether Oracle will become one of the key AI players out there, because they are really betting on this AI infrastructure, or are they going to remain a bit smaller player and behind this hyperscale of bigger cloud leaders? But for now, like this earnings report that we got really supports the positive case for them, at least for now. But execution will be the key.
Yeah, absolutely. Right, let's wrap it up with a quick look at what is happening before we next speak. So tomorrow, for those in the UK, you've got GDP numbers, which will be worthwhile having a little look at. You've got US PCE, so I guess the Fed would want to see that along with the recent CPI before making their decision next week. We can absolutely talk about that on the next Market Bites podcast. We go over the weekend on Monday. You got Chinese retail sales, you got US retail sales numbers as well, and then we got a week really full of central bank meetings. You got the RBA, which will be Tuesday early hours. So we'll maybe get a little bit of a clue about what central banks are immediately thinking there, just about the global situation. You've got the Bank of Canada on Wednesday. You've got the FOMC on Wednesday as well. And of course, that press conference arguably would be the most important thing from a scheduled point of view. Thursday, Bank of England. You've got them, their announcement. You've also got the Bank of Japan as well. You've got the ECB. You've got the Risk Bank. You've got S&B. I mean, wow, it is literally all about central banks next week. You've got UK jobs data also on the Thursday. And then just to make it a little bit more interesting for everyone, quadruple witching next Friday as well. So, Neja, heavy on the central banks next week. We at this point we probably know what they're all going to do. It's all down to what they say, really, isn't it?
Yeah, it is. It definitely is, because at least and I bet everyone out there would like to know what are they thinking, for how long are these tensions going to last, and what impact they're going to have on further inflation readings. And nevertheless, also we had a jobs report last week in the US, and which unexpectedly lost 92,000 jobs, which was completely different than expectations. And I would like to hear about it. Like, what are their thoughts, and what are their plans for future cuts, or possible, like, what is their plan for the next meetings? And I bet Brett, who will join us in the next episode, he's on well-deserved vacation, but I bet that he will have lots to say about inflation in the US, and it's going to be a lot to cover from the macro side and central banks. I think that we might get this view on where they are heading, what are their thoughts, and this will give us maybe something to to hang on to, like, also for investors, how to position ourselves in the following months.
Yeah, absolutely. Bring it on. So next week, definitely central banks, and we'll probably be talking about something we don't quite know about yet, if 2026 markets are anything to go by. Neja, as always, thank you very much.
Thank you, Sam. See you next week.